Most people think saving their first $10,000 is the hard part. But what nobody talks about is what happens after you get there. Imagine spending months, maybe even years, building up that money, watching your bank account grow, and then suddenly realizing you have no idea what to do next. That's exactly where I found myself. I had finally saved my first $10,000, and instead of feeling confident, I felt stuck. I knew one thing for sure, leaving all that money sitting in a regular savings account wasn't going to make me wealthy. Inflation was quietly eating away at its value every year. So I made a decision that would completely change the way I looked at money. Instead of just saving, I was finally going to start investing. The first thing I did was resist the urge to invest all $10,000 at once. A lot of beginners think investing means throwing every dollar into the stock market immediately, but that's not how smart investors operate. Before investing a single dollar, I made sure I had an emergency fund set aside. Unexpected expenses happen to everyone. A car repair, a medical bill, or even a sudden job loss can force people to sell investments at the worst possible time. Having cash available creates stability and allows your investments to grow without interruption. Once I had that safety net in place, I focused on creating a simple plan. Instead of chasing hot stocks, listening to social media gurus, or trying to predict the next big winner, I decided to invest in something that had already created millions of successful investors, low-cost index funds. These funds give you ownership in hundreds of companies at once, reducing risk while still allowing you to benefit from long-term market growth. Rather than betting on one company, you're essentially investing in the entire American economy. I also took advantage of tax-advantaged accounts whenever possible. If your employer offers a 401k match, that's one of the easiest ways to increase your investment returns because you're essentially receiving free money. After that, I looked into opening a Roth IRA. The reason so many investors love Roth IRAs is simple. You invest money today, and if you follow the rules, your future growth and withdrawals can be completely tax-free. That's a powerful advantage when you're thinking decades ahead. One mistake I avoided was trying to time the market. When I first started investing, headlines were constantly predicting crashes, recessions, and economic disasters. But history shows that waiting for the perfect moment usually means missing opportunities. Instead, I focused on consistency. I invested a portion of my money and continued adding to my investments every month. This strategy, known as dollar-cost averaging, removes emotion from the process and helps build wealth over time. The most surprising lesson I learned was that investing isn't really about getting rich quickly. It's about allowing compound growth to do the heavy lifting. A dollar invested today has years, even decades, to grow. That's why wealthy people often focus less on finding the next big thing and more on staying invested for the long term. The real magic isn't in making one lucky investment. The real magic is giving your money enough time to work for you. Looking back, saving my first $10,000 was an important milestone, but investing it was the moment everything changed. That money stopped being something I had to work for and started becoming something that could work for me. If you've reached your first $10,000, don't let it sit on the sidelines forever. Build your emergency fund, use accounts like a 401k or Roth IRA when available, invest in diversified index funds, and stay consistent. You don't need to be a financial expert to start building wealth. You just need a plan and a willingness to take that first step. The sooner you begin, the more time compound growth has to transform today's savings into tomorrow's financial freedom.